Wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Pommy.
Evening, everyone. It's Jim and Graham back for our latest live stream for A-Level Business. How are you doing, Gene?
I'm okay today, Jim. Are you all right?
Yeah, I'm good. Question coming in the live chat. How long is this? Well, we run these sessions for about 20, 25 minutes. Quick fire, a mixture of knowledge questions, MCQs, case studies, a couple of a calculation or two, and a mini case study at the end. And today's topic is all about profit, profitability, and liquidity. Topics that traditionally appear in A-level business papers, but often students underperform you. I think that's fair to say, isn't it?
Yeah, I think so as well. I think what we tend to find is that a lot of students can calculate maybe the profitability ratios, but aren't able to use those to suggest how a business can actually improve profitability. So that's what we're going to look at today.
As always, as people are joining us live, we're going to do the big reveal, and this time it's a brand, quite a well-known brand as well. I've seen the answer, so I won't spoil it. Let's see if anyone can get it before we get to clue 5 or clue 6. Take us through it then, G. Here's our first clue.
Okay, so this brand or this business, was founded in 1937. So if you're sat there thinking, I know a business, but it was founded in 1938.
Can't be
this one. Can't be this one. Clue number 2. First products were made. So it sells things made in North Carolina. That's in America, I believe.
It still is, yeah.
Is it still there? All right, it's not moved. Not one person's got it.
Not yet, but I mean, to be fair, those two clues aren't particularly helpful, are they? Unless you type.
Yeah, I think we might run circles around the audience tonight. So, clue number 3.
Should we take a bite of the third clue, which is?
Let's take a bite of that. So it became a PLC again. So in July 2021. So when I was researching this in depth today, it took me about 6 hours to come up with this. So it was a PLC. It was taken back into private ownership, and it's a PLC again.
Right.
Ray-Ban.
It's not.
That's a bright answer.
Fish out
That's a bright answer. but it's not correct. Well done, though, Lucy.
I couldn't see that answer coming.
You put us in the shade there. So clue number 4. Vernon Rudolph
will do.
was the founder. Baked
Yeah.
beans. I suppose that's a benefit of hindsight, that clue, but no, it's not baked beans. Vernon Rudolph was the founder, so it was founded in 1930. It was actually with his uncle, to be fair.
Right.
But then he set up his own sort of
I think it's fair to say that Vernon came up with the recipe to success, didn't it? It's a very closely guarded secret as well.
It is. Clue number 5. The name is spelt incorrectly for marketing purposes. I think we beat the audience here. If we show the question mark now, we will have definitely beat the audience. So maybe another couple of seconds.
It doesn't often happen.
Doesn't, so we're going to get it? Yes. Oh, well done, Lucy. Well done. Well done there. Yeah,
I didn't know that was incorrectly spelt. I just assumed that that's how it was
How you
spelled.
spell Krispy Kreme?
Yeah. Hey, Graham, didn't you try to get a bank loan for a donut business?
I did, yeah, but they found a hole in my business plan. They did, yeah.
Right,
Do you know why I was going to set up a donut business? Because I already work full time. I need the dough. So Krispy Kreme. You know what?
Yeah,
I've never had a Krispy Kreme. I get done from Great North Donuts, here in Sunderland and Newcastle. I've never had a Krispy Kreme.
You usually find them, don't you, in the entrance to supermarkets in the
Yeah. I see a lot of students in our workshops. You know, when we do our workshops, come in after dinner with a huge tray of Krispy Kreme donuts.
And do they ever offer you one? Never.
Never. So if you are coming to one of our workshops and you fancy a Krispy Kreme donut, save one for me. So,
anyway.
So we've got 5 MCQs here. So the formula for calculating operating profit is our first one. It's spelt wrong, but it's still pronounced cream. Well, I thought it was Krispy Kreme, like.
We learn something every day.
Every day's a school day. So it's a formula for calculating operating profit: A, B, C, or D. So you found a hole in my argument there as well. So A, B, C, or D. What do we
sure
think?
how long you can sustain this for another 20 minutes.
I can't.
It's quite an important formula, isn't it? Operating profit.
Yeah.
We need to know not just what the formulas are, but also how you can influence them.
Yeah, that's true.
Answers coming in. Lucy and Nikita both saying the same letter. And it's definitely one of those 4.
Definitely. I think most people are going for D.
Yeah, definitely. I would say 90% of people are going for D in the live chat. Let's have a look, shall we?
Yeah, it is. It is indeed D. Sales revenue minus cost of sales plus operating expenses. Well done, everyone. Yeah. So can't emphasize enough knowing your formulas.
Got it on. We'll use that later. Here's the next one. The gross profit of a business. We've not given the business a name, but anyway, the gross profit is £400,000. Cost of sales is £300,000. With that information alone, can you work out what the sales revenue of the business is?
Yeah, that's a difficult question. We've done a similar question in the workshops, and a lot of students struggle. And again, you really need to understand, I think, your financial statements: income statement, profit and loss, balance sheet, statement of financial position. Sorry. So I think you need to know. Wow, I tell you what, we're so quick on the mark here, aren't we? We are quick on the mark. Lots of students going for C.
Yeah, a few more seconds. Certainly see the right answer. Let's have a look, shall we? The answer. What? The answer is indeed C. Yeah, £700,000. So don't forget the formula to calculate gross profit is sales revenue less cost of sales. Well, we almost have to reverse engineer it, don't we? We know what the answer is: 400,000. Well, sales must be 700,000 if 700 less 400 is 300. So well done.
Well done.
If you said C, well done.
Yeah, well done.
That's 2 questions gone. Here's our third.
All right, so 2 statements here. No MCQs on the Excel spec, but they're just such a great way, aren't they, Jim, of testing a lot of knowledge and understanding. So statement 1, the formula to calculate the current ratio is current assets divided by current liabilities times 100.
Yeah.
Is that true or false? The profit for the year of a business considers all the costs incurred by the business during the year. So are those statements true or false? Now, remember, if you're an Excel student, you've got the asset test ratio, which is another liquidity ratio. It's not on the AQS spec.
Yep.
So I'm just be mindful of
Not well
that.
understood, if I recall from the 2025 papers.
Examiner's report, yeah. So the asset test ratio was examined, in this year's paper 2 for Excel, and some surprising. I don't want to give the game away because it relates to an activity we've got, but we'll talk about that.
Anyway,
after.
look, we're struggling to beat tonight's live stream audience. If you're watching on catch up, hopefully you're doing as well as the live team here with Lucy and Liz and Nikita and others. Smacking out the park today. The answer is
Yeah, it is.
indeed.
Yeah, it is. Yes, yes. So we don't multiply. We don't multiply by 100.
No.
Some students do, which is incorrect. And what more can I say about statement 2 apart from it is true?
Yeah. It's the final profit, isn't it? It's your revenues less all your costs.
The bottom line.
Good
The
stuff.
bottom line, Jim,
The
isn't it? The bottom line. The bottom line's the bottom line. The bottom line.
Moving on. Now, which of these, and it's which one of the following, so there's only one, is likely to lead to a lower net profit margin for a manufacturing business? So it's just one of those, a lower net profit margin. Now, that would be bad news, wouldn't it? That would mean that we're making less profit as a proportion of sales.
Yeah.
So one of those might be a reason why you would have a lower net profit margin. You could reverse engineer that question, couldn't you? Because that would give you some ways in which a business could improve its profit margin, or manufacturing could improve its margin. But we're looking for one, and let's have a look. I would say most people in the live chat, not everybody, but most people are going for answer B. Let's have a look, shall we?
Yeah.
It is indeed B. Yeah. Well, I mean, the reason for this is that a falling capacity utilization is normally bad news for profit margin, because it means you're not selling as many units, but you've still got the fixed costs. Therefore, you're not making as much contribution towards those fixed costs. That tends to result in lower profit as a proportion of sales. All the other three, actually, in theory, should improve the margin, shouldn't they? High labour productivity, that should improve your profit margin. Lowering the amount of waste, the cost of waste, less waste, that's going to reduce costs. And similarly, discontinuing an unprofitable product range, well, that's going to get rid of unprofitable sales. Yeah. So what should be left should be more profitable sales. So in fact, the answer is B. Yeah, well done. We've got certainly one more, maybe two.
Okay, so again, two statements. The introduction of just-in-time can improve, or just-in-time production can improve the liquidity of a business. That's true or false? Working capital is the difference between non-current assets and non-current liabilities. And working capital has been specifically examined by Edexcel. Again, that was highlighted as an area of weakness, but we should really know, shouldn't we, about working capital? It's intrinsically linked to liquidity, so it's a really, really important concept. So lots going for. Well, do you know what? We've got a bit of a mixed bag here. We've got C, B, D, and A.
I'd say half the audience live are going for A, but quite a few B's and D's.
A. Is that A?
A.
Right. So yeah, shall we reveal the answer?
Let's do it.
Yeah, so statement one is true. Yeah, so basically, just in time means products are arrived. I think Nissan's a really good example. The tyres at Nissan for the cars arrive generally half an hour before they're put in the car. It means that less money is tied up in stock, which can therefore improve cash flow and subsequent liquidity. Yep. Working capital is the difference between current assets and current liabilities, not non-current assets and non-current liabilities. It's the money that's used in the day-to-day running of the business. So the difference between current assets and current liabilities. But just in time, yeah, that's a really, really important concept. So just ensure that, we know that it can improve liquidity as less money is tied up in stock, as we just get the products or supplies when we need them.
Yep, exactly that.
Great stuff.
Working capital is very closely linked to the whole idea of the current ratio, isn't it? So it's a liquidity concept.
Definitely.
And, well, we've done our 5 MCQs. I think we did well on those. I think that last one was a tough one. It is time for our first calculation. So, would you believe it? We've got a real business that exists called Foam Alone. Do you want to take us through this one, G? I think this is quite a nice one.
Yeah, so Foam Alone is a producer of washing powder that doesn't need softener. So it foams alone, which is quite interesting. The table shows some selected financial data relating to the business. So we can see some information there. Cash, inventory, overdraft, receivables, payables. Can you calculate the current ratio of Foam Alone based on the numbers you see on screen? I think we've got a little time as well, haven't we? So I think this can be quite a difficult question. You've got to know what current assets, you've got to know what current liabilities. And one of those, well, I'll explain after, was highlighted in this year's examiner's reports as a minor issue. So should we start the clock?
Let's start it, yeah. We've got a minute to calculate this. Obviously, in the exam, you'd have a bit longer.
A bit more.
But we want to finish this live stream before Celebrity Traitors, don't we? So
I've never seen it. I'm not watching it. So one week to Rami and said, "You've got to watch it, Dan. You've got to watch it."
Best show on telly by a mile.
Really?
Yeah, amazing.
I'll binge watch it when it's finished. Just don't tell me. Which one was? I'm thinking of Celebrity Hunted. Is that the one where people get caught? Anyway. form alone.
Current ratio. We mentioned the formula, didn't we? In one of the MCQs a few minutes ago.
Yeah, current assets divided by current liabilities. So no shame in not knowing that, but we need to identify what are current assets, what are current liabilities, and therefore what the answer is.
Yep.
So maybe people still typing, maybe we're a bit unsure as to. I think the secret here is with questions such as this. Oh, Nikita's in there.
I think we've got the first correct answer in. Let's stick that on the screen. Lots of answers coming in.
Yeah. Now, just remember, just try and listen. It's a minor point, but we should really be expressing that to 1 because it's a relationship between current assets and current liabilities. So really, 1.75 to 1.
Yeah, to
that's
1.
what we're after.
Yeah. You wouldn't normally be Dr. Mark, but it's to be on the safe side.
Yeah, just be on the safe side. Let's get the. It's yeah, you're right. You wouldn't normally, but chance leaves nothing to us in life, Jim. We should leave nothing to chance.
Talking of which, our answer is expressed to 1.
To 1. There you go. So now the asset test ratio came up, Jim, in a net Excel paper, and it was highlighted. A lot of students didn't know inventory was a current asset. So so you got cash, which obviously is it's a current asset. Inventory is, and it's sometimes students get confused between receivables and payables. Receivables is a current asset because you're waiting for that cash to be received. Payables, you're paying it out. That tells us why I think it's important to express it to 1, Jim, to be fair, is that tells us for every £1 of current liabilities, that business has £1.75 of current assets. So that's why I think really we should be expressing it to 1. But as long as you got the answer right, that's all that matters. Well done, team business.
Yeah, and as always with the calculations, we always show our workings. And if you're not quite sure about the calculation, just write down something about what you think the formula or the answer is. Never leave a calculation blank.
Never.
We've done well there. That wasn't an easy one. Let's move on to our application spinner. We do one of these each week, and in this situation, we, using the power of AI, as we all know, it's random. We pick one business from the 6 selected, and we try to apply the question to that selected business. And here we're talking about liquidity again. The question is, how might the following business, well, we don't know which one it is yet, how might the following business improve their liquidity? Let's spin the wheel.
So some new businesses have appeared this week,
Not many,
Jim
though.
Shark, Ryan S. Well, 4, Jim Shark, Ryan S. scored an audience.
Yeah, fair dues. Yeah.
So Jim Shark, wow. Are you a Jim Shark fan?
Well, I'm a massive fan of the business. I don't wear Gymshark. I'm sponsored by Adidas. But
great stuff. So how could Jim Shark then? How could Jim Shark improve their liquidity? So I think it's about applying our knowledge of liquidity, and then to a specific business, because every business will be different.
Yeah.
So yeah, I have seen they've got a store on Oxford Street, haven't they?
They have now, and they've got one in Westfield, Stratford, and White City, where we go for the workshops.
We'll be there in our workshops. So but they're big online, aren't they? They're big online business.
Online.
Really.
Yeah.
In the parents' garage, I believe. So
the thing about Gymshark is, so it's fitness apparel, gym wear. So, and it's selling online. So obviously that's going to involve inventory and stock, isn't it?
What type of stock?
Not so many, leggings, tops, and
hoodies,
that kind of stuff. But it's probably not got many receivables, because I think most customers probably pay cash or credit card.
That's true. And I know they don't manufacture. Though that's really good. That
answers flowing in now. Let's take one of the
I like the word fabric there. So Jim Shark could try and negotiate longer credit terms with their suppliers, for example, extending payment periods for their fabric in order to ease pressure. Yeah, good application there. I like the word fabric.
Yeah, so if you extended your credit terms, your trade payables would go up, but you'd also have more cash in the bank.
Let's put Nikita's on there. Holding less stock. I mean, that's perfect, isn't it? You would imagine a shop like a Gymshark, it needs to carry all the different sizes and styles in range, to meet demand.
Yeah.
So maybe carrying less stock, maybe less of the more unusual, sizes or styles don't sell as well, for example, Like
I don't know how seasonal or fashion conscious the Gymshark range is compared with some of the fast fashion operators.
That's an interesting one about leasing equipment rather than buying it. That's quite interesting. Quite interesting point, that, Lucy. You could lease some of the equipment needed. Yeah, that's really good. So you're reducing your cash outflows there, aren't you?
Yeah, reduce cash outflows. That should increase cash balances, which therefore improves the current ratio, doesn't it?
That's really good. Should we have a look at what we had?
Hard to beat that one. Let's
Hard to be that one. So let's talk. So Gymshark have lots of cash tied up in stock. There's such as seasonings such as leggings and hoodies. They could reduce inventory levels, which I think Nikita mentioned.
Yep.
And we've linked this to, this is where really good answers come from, Jim, is trying to link different topics together to get a synoptic answer by reducing inventory levels by using previous sales data to more accurately predict which sizes and styles sell the fastest. This could help them avoid over-ordering from their gymwear manufacturers, meaning they have lower stock levels in their warehouses and stores. I think quite important. Sales forecasting, looking also maybe at historical data to see what actually, as someone who's 6'5", I would imagine, there's not many people my height, therefore maybe sell a lot, maybe stock less of that range or whatever for those sizes and styles. Carrying less stock. But what we've done is we've really explored the hows and the whys, haven't we, Jim, there?
Many years ago, I used to have a client, which is a very, very well-known retailer, ladies fashion retailer. And they knew the names of the customers who had a particular, say they were very tall or whatever. They actually knew the names of the people who come in. And therefore, they only needed to stock a few garments.
Yeah. Garments is a good.
Thank you very much.
Garments is good garments. That's what type of words we want in when we're talking about like clothing, don't we? Garments, fabric, things like that. Yeah, so they knew them by person then. That's quite interesting.
I love that one about the leasing one. I hadn't thought about that. That's absolutely true. If you lease things rather than buy them, that increases your cash. And therefore that improves your liquidity. So you could say lease their fixed equipment such as tills for the stores.
Especially in the short term.
Robots for the warehouse.
Great
Fantastic answers. Well done. Well, we've got one more calculation, and there's a bit of a theme to this tonight, isn't there? Washing machines, washing powder.
Yeah, washing powder. In a Spin sells used washing machines online for £200 per washing machine.
Okay.
The variable cost is 40% per washing machine of the selling price, and a yearly fixed cost of $1.5 million. It estimates it's going to sell 20,000 washing machines this year. What is the estimated monthly profit? Now, there's two ways you can calculate that. The traditional way, total revenue minus total costs. But you could also use the contribution method, which is far quicker. It'd be interesting to see which method students use. Yeah. But as long as we get the answer right, that's all that matters. Should we start the?
We've got the 1 minute clock. We might allow a few extra seconds for this because there's a little bit of work.
It's a long question. This.
What is it about you and washing machines and washing powder, Graham? You're always using them in these live streams.
Yeah, no, I should put sock in it, shouldn't I, really, when I'm talking about my love of washing machines, really. And I don't know why. Do you know what? When I was writing it today, I was doing my washing, and I thought, you know what? I was a bit in a spin, really. So there we go. It's something we all, it's one of those things we all have, don't we? Well, most of us have, to be fair. Not everyone has them, but they just go unnoticed, don't they? They are the backbone of our lives. Yeah, they are. They're really important. It's one of those things that when they break as well, you're furious because you've got to spend £600 or so on a new one, and they add very little extra value to your life, to be fair. But you need one, don't you? You need one.
Anyway, back to the estimated monthly profit.
Yeah, that's what we want. Yeah, that's what we're after. So it's whether students have worked it out monthly. I'd be interesting to because obviously I know the answer, so I know what the yearly amount is. Yeah. But you know what the thing is. Oh, look at that! Oh my word!
I think the first answer coming in was from Joseph. I think there's quite a few similar answers. Literally a nanosecond later, but I think that's correct.
Be interesting if just to show maybe in the chat window, if you could let me know if you worked it out using TR minus TC, which is total revenue minus total cost, if you worked it out that way, or if you worked it out maybe the contribution method. Both methods are fine, but there's a way to work it out really, really quickly. Yeah. So I'd be interested to know how many students used the contribution method, or just used because from that you can work out break even as well, can't you? You can even work out the margin of safety. There's a lot we can do with those numbers. So Nikita used total revenue minus total costs. Yeah, that's great. Yeah, absolutely fine. We'll go through both methods, I think, and I'll explain the contribution method because I think it is relatively useful. Lucy used contribution there. And what a contribution to today's live stream, Lucy, as well. Lots of great answers coming through.
We'll go through both calculations. One is slightly quicker, but they both get to the same answer.
Exactly. Okay. 75,000. So the top one is using total revenue minus total costs. So we can work out the estimated sales revenue, number of washing machines sold by the price. We know the variable cost was £80, 40% to 200. So we work out the total estimated variable costs, which was 20,000 times that £80, so 1.6 million was the total variable cost. We add on the fixed cost to that to get 3.1 million. and therefore 4 million minus 3.1 million divided by 12 is our £75,000. So
Yeah,
so
profit of 900,000 per year, which is 75,000 per month.
But the contribution method is quite interesting because a lot of students think the difference between the selling price and the variable cost per unit is profit. Well, it is profit if the fixed costs are being covered, but if not, it contributes towards covering the fixed costs. And using that theory, Jim, so total contribution minus fixed costs must be profit. So we know each washing machine contributes £120 towards covering the fixed costs. 20,000 washing machines times by the contribution per unit is total contribution of 2.4 million. That's not profit because we've not taken into account the fixed costs, so we just knock the fixed cost off. Divide by 12, and then we've got 75,000. So we're reducing 2 steps there in the process, really, which could save a little bit of time. But as you correctly point out, Jim, it's about getting the right answer. We don't want you in a spin in the exam. Make sure you use a method you're confident with as long as you get the right answer. That's what we're after.
Step by step. Step by step. Well done. I mean, the accuracy of the live stream audience tonight is impressive, to say the least. That is our last calculation, I believe.
It is. One mini activity.
One mini case study to finish off with. And would you believe it?
Oh, wow.
We've moved away from washing machines and washing powder to Graham's second favourite topic of this week, apart from doing his washing, which is donuts. A donut and coffee shop in Sunderland, Graham. It's unusual for Sunderland to have artisan shops, isn't it?
Well, you say that, but we're sitting on the up, Jim. You know, we've got Premier League football now. I'll tell you what that is at some point. So, donut disturb. Oh my word! It's a donut and coffee shop in Sunderland. It sells artisan donuts that are handmade in house each morning using slow-proved dough, real butter, and natural flavourings. The coffee, Jim, uses only the finest, ethically sourced beans from small farms in central
and
beans?
South.
I can't pronounce it. I can't see it actually. I'm not with glasses on. Arabica, is that right? Have I pronounced that correctly? Yeah. It's what type of beans? Big beans. So the coffee uses only the finest, ethically sourced beans from small farms in Central and South America. Staff are paid above the minimum wage and trained regularly to help ensure excellent customer service. Sales revenue last year was 180,000. Gross profit was 50,400. Operating profit was 10,800. How could they improve their profitability? Now, the way I would approach this, Jim, if I could, I'd work out the ratios, and that would give me an understanding where the issues lie. From that, you could work out gross profit margin. You could work out operating profit margin, and then using those figures, you might come up with a solution or a suggestion on how they could improve both of those ratios. So this type of activity, AQA and EdXL love this type of activity. AQA Paper 3, and EdXL Paper 3 love this type of activity, using numbers and ratios in order to support your analysis and your evaluation.
Exactly, because you're not explicitly asked for a calculation, are you? So there's an expectation you'll use the information, but you're not explicitly asked for it.
Yeah, at Excel Paper 3, you let down that route. But AQA, you're not. You just basically got to try and work it out. So Nikita's come straight away there. Good answer. So try sourcing the coffee beans from someone else to reduce costs. So then we would say, well, actually, that would reduce cost of sales. Yep. Therefore, that would boost the gross profit margin. But you're right, this could compromise quality, which could lead to lower sales revenue, which could negatively affect the profit margins, couldn't it, if sales revenue is lower? Proportionally lower compared to the costs. So if we could try and link that to the ratios, that would be great in profitability. But Nikita, that's a great answer.
And I think the other thing is, if you reduce the quality of the coffee, that's going to bring less customers in who are going to buy fewer donuts. And presumably, donuts are the thing you make the money on.
Yeah. Because it's called donut disturb.
Yeah, so there's an implication if your coffee's rubbish, chances are you're not going to go for a donut and a coffee, are you? You're not going to go for either.
Yeah. So I got the inspiration. I went to Great North Donuts on Wednesday. I ended up getting 2 donuts and a coffee, to be fair. Right. So, but anyway, so there we go. Any other suggestions? Anyone work the ratios out? So it's got a very low operating. You can tell it's got a very low operating profit margin just for the numbers. But what is the operating profit margin? Really good if we can use the figures to support our answer.
I'll keep a look. I'll keep an eye out in the live chat. We've got some. Hang on.
A subscription scheme, free coffee after 8 visits. So that could boost sales revenue, then, couldn't it, in the long term? So boosting sales revenue could lead to an increase in both gross profit margin and operating profit margin, depending on if they can keep control of the costs. So yeah, so that's a good answer. So what we want to try and do is with all these answers is link it to profitability.
Yeah, so one way we know to improve profitability is to increase sales revenue, isn't it? And so Lucy's idea there is a cracker, which is here's one practical way, rooted in the case study, of increasing sales revenue, and then you just explain how and why that may impact gross profit and ultimately net profit.
That's a great answer. You know, that answer's difficult to top, Jim. You know, I certainly never glazed over when I read that answer, to be fair. So, should we see what we had then? Should we see what we had? So reduce costs. So their gross profit margin appears low, 28%. So that was just gross profit divided by sales revenue times 100. And their operating profit, that is really quite low, isn't it? I mean, we need to compare it with maybe other businesses in that industry or previous, but it looks particularly low. This is Nikita's point, sourcing cheap ingredients for their coffee and donuts. May help to reduce. Nikita's come in there with the answer. Yeah, that's great to see. So Nikita's got the correct ratios there. Brilliant.
Yep. And if you use those in the answer, that is application. It's more than just application, isn't it? Because actually it adds to the depth and the quality of the analysis.
Yeah, what was interesting is that, you know, it was said in the case study there that, the employees are paid well above the minimum wage. Now, obviously, you can't start just reducing existing staff's wages, really. But any new employees, you might maybe employ them on slightly cheaper salaries, which therefore would reduce operating costs, which may boost operating profit. But then again, you've got to would that compromise customer service, which may impact sales revenue. This is all about balance. So Lucy there, Lucy's coming with the one of the figures as well about lowering waste. That's a great answer.
Yeah, waste such as donuts that are thrown away would be application, wouldn't it?
Yeah. Now, this next one is quite interesting. Is you can go quite complex with this second point about increasing sales revenue. You could argue, because they only use like the finest coffee beans, their donuts and coffee are relatively price inelastic, which means if we increase the price, the quantity demanded will fall, but lower than the percentage increase in price. And if the quantity demanded falls, our variable costs will fall. Therefore, our cost of sales will be lower, our sales revenue will be higher. That will improve profitability if my chain of reasoning's right. I never fully explain that on there because obviously we're tight for space. But if it is price inelastic and you raise the price, that could boost sales revenue. That would improve both the gross profit and operating profit margin. But it's important to know that if you sell less, your fixed costs don't change, but your variable cost per unit will be lower because you're selling less donuts and coffee, but your sales revenue increases.
I think Lucy's point about increasing revenues by introducing a subscription scheme is a cracker there, isn't it? Because that should make demand less price elastic, shouldn't it? In other words, I've now got a reason to keep on buying whatever the price. The coffee and the donuts from this business.
Some great answers there, everyone. Really, really impressive, especially for some people. So some people will be on half term and have joined us during their half term break, which is great to see, isn't it, Jim?
It certainly is, and I do believe next week. I know some people are still on half term or having their half term. I think we're having a Halloween special, aren't we?
Spooktacular
Halloween themed revision session, same time, 6 p.m. on a Wednesday. Thanks to everyone who's joined us live. If you've been watching on catch up, because we know that a lot of teachers set this video for homework and work their way through. Hopefully, you found it useful. And G, anything else to say before we sign off?
No, I'll be here next week. I definitely won't be ghosting you, Jim. I'll be here. And on that note,
you've got 7 days left to come up with a different case study and some different puns. Lucy and I've
assumed a new identity as well. I'm now Jeff.
Well, could be worse. We're off to go get ready for Celebrity Traitors, apart from Graham, who's not seen any of it so far.
No, I don't watch it. I'm watching.
But you should. It's amazing. We'll see everybody again 6 p.m. next week. Cheers, all.
Cheers.